Hello, everyone. Richard Green here again, talking about our topic for week two, which is mortgage participants. And I think I should be a little more specific when I say mortgage participants when we're talking about who supplies mortgages. Obviously, people who borrow are also participants. We're not going to talk about them quite just yet, but we're going to talk about the process that gets money to the people who want to borrow it. And it's not as straightforward as most people think. I imagine that most people think that when they get a mortgage, they go to a bank. The bank has a bunch of money in it. They give the people the money with the expectation that it get repaid. That used to be the way things worked in the United States until about the 1970s, but now we are largely a capital markets financed mortgage system. And we're going to talk about that. And we're going to talk about how is it that the person who you interact with to get a mortgage deals with the people who are actually going to fund that mortgage? So that's what we mean by mortgage participants. So with that, let me share um, screen. There we go. And okay. So let me start by telling you about a really great resource. The Urban Institute puts this out. Full disclosure, I'm a non-resident fellow of the Urban Institute. A number of my students now work at the Urban Institute. A current student of mine used to work at the Urban Institute. So the point is, I do have pretty close ties to these people, and so maybe prejudice, but they do put out something called the Housing Finance at a Glance monthly chart book. This is the link to it, and every month they update information about the state of the mortgage market in a very useful way. And we're going to talk more about this chart book in a couple of weeks, but I am going to refer to two things from it today. And this is something you should be very familiar with if you're interested in the mortgage market. So let's start by talking about who originates loans. So, who are the people that you interact with when you are applying for a loan? And as I'm about to show you, more often than not, it is brokers. It is people who do not have money themselves, who are basically looking for loans to sell to the capital markets. So they are basically a market maker. They are the intermediary in between the supplier of the money and the demander of the money. Okay, and we're going to talk a little bit more about that. Sometimes these are known as TPOs or third-party originators. Correspondent lenders. These are people who have basically been given the authority on behalf of usually a bank to make loans. But the expectation is that once again, the loans are going to be sold into the capital markets. And you can sort of think as a bank as being the backup if it doesn't work for capital markets, the correspondent lenders make the loan. Uh, if that were to happen too often, they would cease to be correspondent lenders. And then finally, direct lenders. And that's who I think most people think about when they think about lending. It's people who have deposits, banks, savings and loans in the old days, and would take those deposits and use it to fund mortgages. So let's see who is actually doing the lending right now. So if we look at origin non-bank origination share, so these are the share of loans that are being made by non-banks that are being funded by Fannie Mae, Freddie Mac, or Ginnie Mae, and we're going to talk about them in a moment. You could see that currently about 83% of all loans are being made by non-bank lenders. And the largest lender at the moment, or the largest, I should say, originator at the moment, because they're not technically a lender, is Rocket Mortgage. And Rocket Mortgage is famous for buying very expensive ads for the Super Bowl. They are really a big dog. And the interesting thing about them, if you're a consumer, is they are providing service at a relatively high price. So it's almost always the case that you can get a loan with a cheaper interest rate if you go somewhere else. But what Rocket does, because of their sophisticated algorithm, is give you an answer about whether you're going to get a loan or not very quickly, sometimes within 30 minutes relative to other lenders. Okay. But you can see, again, about 83%, 84% of loans that are sold into the secondary market are originated by non-banks. If you look at Ginnie Mae loans, and I'm going to talk about what they are in a few minutes, it's more than 95%, Fannie and Freddie about three-quarters of all loans. Okay. And if you go back just as recently as 13 years ago, you could see that non-bank share was considerably lower in the neighborhood of, I don't know, 20 to 40%, depending on the type of loan product. So we'll talk about a little bit why that is in a moment. Okay, so who funds loans? Fannie Mae, Freddie Mac, and Ginnie Mae have a substantial majority of the business right now. Then you have banks, Citibank, Wells Fargo, your local bank, etc. Insurance companies a little bit, but usually nowadays through Fannie, Freddie, Ginnie. Pension funds a little bit. When you're looking at the commercial market, pension funds are very important in that market. Insurance companies and banks are too, although a little less so. Private equity is increasingly in the loan business, and we're going to have a whole class devoted to private equity. So we're not going to talk about that much today. And finally, mortgage REITs, which are publicly traded companies that are in the business of just buying and selling mortgages and trying to make money for their investors that way. And we'll talk about them again later. Today, we're really going to focus on Fannie, Freddie, Ginnie, and banks. Now, why is it that banks have such a small share of the mortgage business right now? Well, it's a couple of reasons. First of all, is from the standpoint of a bank's balance sheet, a fixed rate mortgage is not a good investment. And we've seen the reason for this quite recently. And this is the reason why Silicon Valley Bank got in trouble, why First Republic got in trouble, and so on. So banks borrow from depositors, and sometimes the rates at which they borrow are very low. 5 years ago, it was basically nothing. So they make a mortgage, they keep it on their balance sheet. 2.5 years ago, excuse me, 5 years ago, that mortgage rate may have been 2.5%. A bank is making money on that spread. So they're basically borrowing at nothing. They're earning 2.5%. So that's a 2.5% spread. And here's a handy formula to you. If you take the spread between borrowing costs and investment returns and multiply it by a leverage ratio, you get your return on equity. Okay, banks are generally levered about 10 to 1, which is to say that the amount of investment they have is 10 times the amount of cash that they have in the bank. Okay, and the definition of cash is retained earnings plus money that they take in with stock offerings, stock issuance. Okay. So they have that 10 to 1 ratio. They were making a spread of 2.5%. So that's a 25% return on equity. That is really, really good. But here's the problem. Okay. Remember, those 2.5% loans usually had a minimum fixed rate of fixed term of 10 years, and more often than not had terms of 30 years. Excuse the phone ringing. So what's happened to interest rates since then? Well, short-term rates have gone up by more than 350 basis points, 3.5%. Okay, remember they were making a positive spread before? Now they are making a negative spread. Okay, their return to the investment, that 2.5%, is less than the cost of borrowing to them. And sometimes that cost of borrowing is now 4. So here is, by the way, one of your exercises for today. I want you to go to a website called Fred, which is from the St. Louis Federal Reserve Bank. And I want you to graph mortgage rates and federal fund rates on one graph and see how there's been a difference over the years in the gap between the two. Okay, coming back to banks. So the problem for a bank is that once those borrowing rates go up above the fixed rate mortgage, they're now losing money, losing quite a lot of money on those mortgages. And that was, in fact, one of the key components to Silicon Valley Bank, which went out of business, and First Republic Bank, which went out of business, to them going out of business. Okay. So that's one reason banks generally are not in the fixed rate mortgage game anymore because short-term rates are too volatile for them to do that. The second thing is liability. This is something that Jamie Dimon has talked about. He says he really doesn't want JP Morgan Chase to be in the FHA business anymore. And we'll talk about what FHA is in a bit. Because if it turns out you made a mistake in underwriting that FHA loan, Federal Housing Administration loan, the insurer of that loan, which is the Federal Housing Administration, can come back and require you to not only eat that loan, but to pay what's called treble damages back to the FHA fund. And so Jamie Dimon decided that that risk wasn't worth it. He actually said it out loud. I think other banks have been quieter about it, but it's why banks are really not in the FHA business anymore. Okay. So we overwhelmingly rely on these entities called Fannie Mae, Freddie Mac, and Ginnie Mae. Okay. And so here, if we look at the volume of securitized first lien loans, overwhelmingly, if you look at the gray and the sort of blackish brownish line, you will see that that is a majority of the loans being originated. Blue, there's a little sliver of blue. Those are things called private label securities. They were a very important part of the market during the mortgage bubble of about 20 to 25 years ago. You could see now that they are a tiny fraction of the market. And then the remainder are portfolio loans. Okay, so who is going into those portfolio loans? Is there are loans that don't qualify for Fannie, Freddie, or Ginnie treatment because there are limits on how big those loans can be. The idea is because Fannie and Freddie are actually now owned by the government. They weren't before 2008, uh, except that Fannie was before 1968, that only a certain segment of taxpayers should benefit from them. And Ginnie Mae is completely backed by the federal government. Okay. So, um, all right. So what's the difference between all of them? What Fannie and Freddie do is provide private mortgages and guarantee the mortgages themselves. You could think of Fannie and Freddie as companies that do securitization and provide insurance. So what they do is they will gather a bunch of mortgages up, turn it into a security, and say to the investors of that security, you don't need to worry about being repaid because we will guarantee your repayment. Okay. Fannie and Freddie issue their own securities. Okay. Sometimes there are securities that have both loans bought by Fannie and Freddie, and then that's a relatively recent phenomenon. But think of Fannie and Freddie as sort of aggregators. They take a whole bunch of mortgages and they will go into the market and try to sell them. Or more frequently, actually, they will say to the market, give us money and we will find mortgages to fill in your security with a certain rate. What Ginny does is something different. Is Ginny doesn't guarantee mortgages because FHA, Federal Housing Administration, VA, Veteran Administration, and FMHA, Farmers Home Administration loans or farm loans are guaranteed by the government itself. It's the loans that are guaranteed, not the securities. But what Ginny does is guarantee that if something goes wrong with these loans, there won't be a cash flow problem for the investors in these loans. And I'll talk more about that later. So, and as I already said, Fannie and Freddie are issuers, Ginny is not. Okay, so how are loans priced? Let's take a look. I'm going to stop sharing here. Here is a website that gives an example of a pricing matrix. So let me share a pricing matrix with you. Give me just a moment here. Okay, so this is a classic pricing matrix that a wholesale lender is called Change in this case, but you can find these all over the place, providing to originators. And this is really important in understanding how loan pricing works. Now, let's start by talking about what do I mean by pricing? What I mean is relative to $100, we talked about this a little last week, relative to $100, how much does this cost? Okay. So to the investor. So is it more than $100 or less than $100? So let me try to make this larger. Zoom in. Forgive the, there we go. Okay, this is as large as it gets, so sorry about that. I am going to upload this sheet also to Brightspace so you can take a look at it. So let's start by looking. So this is 30-year loans, and these are what are called conforming loans. And conforming loans are loans that fall under the conforming loan limit, which is a little over $1.2 million loans for Fannie and Freddie. Okay. So how are we going to look at this? Is over here you could see a set of rates ranging from 5.7% to 7%. And I'm going to put on my reading glasses here so I see better for you. And here is a price, and along with it is a lock. Now, the point of the lock is to guarantee borrowers a certain rate. So when you apply for a loan, you could apply for a 30-day lock, 45-day lock, 60-day lock. 30 is probably not enough because usually it takes longer than that to close on a loan, but 45 is probably safe. And then what is the price of the loan based on the rate and that lock? So let's take a look at the rate of 6% here. And up there, we can make it a little like that. And you can see at a 6% rate, that second column is the 45-day lock. The price is 2.41. Okay, what does that mean? These positives are going to turn into negatives. So 2.4 means you're going to take that 100 and subtract 2.4 from it. And so you're going to get a price of $97.60 for that loan. What that means is if you offer loans to the market with a coupon of 6%, the market is only going to be willing to pay $97 and what was it? 60 cents? I just want to make sure I got that right. Yeah, 2.4. So just we'll round it off. $96.60, $97.60. Okay. And so think about if you buy a security for $97 and it's paying 6% on $100, you are earning more than 6% on that rate as the investor. Okay. Now you will observe that as prices go up, this price adjustment is going down, which is to say, from the standpoint of the seller, it is going up. And so, if you can offer a higher rate to the capital markets in terms of what you're offering in terms of return, the capital market is willing to spend more and more for that. And this changes every day and is a little different depending on what region of the country you are. So that is the basic foundation you'll see you have here: the term of the loan, the lock of the loan, the rate of the loan, and that will tell you what you're going to get when you sell it in the capital markets. Okay, this is why when you go get a mortgage, there are basically going to be three options available to you. Option number one is you just get a rate and you pay points, and that's going to be the lowest rate that's available to you. Option two is you get a rate and you don't pay any points or fees, but you do pay as the borrower for closing costs, which are things like an appraisal, like title insurance, etc. Or number three is you pay no closing costs at all. Okay. If the lender is able to sell the loan for more than par, they can use some of that profit in order to finance your closing costs for you. So one thing I recommend is when you're shopping for a loan, always go to at least two lenders and ask them the rate on their no cost loan, which means all closing costs are covered. Because if you do that, then you'll be able to have an apples to apples comparison from one lender to another. Now, the other thing that happens are things called loan level price adjustments. Okay. And what these reflect is the combination, are the combination of FICO scores, which is the quality of your credit. We're going to talk more about FICO later in this course, and loan to value ratio, which is essentially the opposite of how big a down payment you put down. Loans that have low down payments and high FICO scores are more valuable in the capital markets. So you're going to get a higher price for them than loans with high down payments and low credit scores. Okay. Sort of obvious, right? And you could see this in this matrix here. Okay. Finally, if you look at the bottom, there are all kinds of other adjustments. Is it a second home? Is it a two to four? Is it a condo? By the way, disagree with some of these price changes, and we'll talk about that in class. Two to fours are every bit as safe as single family houses, but this is what the pricing is. That's why I think it's actually a good opportunity when you can buy two to fours into a portfolio of loans or have it securitized. But it's basically the same idea. So the riskier the loan is, the less it's going to be able to fetch in the capital markets. So here is something I would like you to do. Here's my other question for you is think about, again, we'll use a $500,000 loan. Suppose it has a current interest rate of 6.5%. You charge the borrower half a point for that loan, but agree to pay for the appraisal, which costs $500. Assume that it's just a plain single family purchase money loan. So it's not a refinance. It's a 30-year fixed rate mortgage. You have a 45-day lock on it. That the borrower's FICO score is 740 and that they put 20% down on the loan. Okay. So you're going to have to go through all that again. Listen, just write it all down. Again, the point is I want to make sure you're watching. Tell me, what is the profit that the lender makes under those circumstances? And when I say lender, I see I screw up too. The originator makes. So the originator is selling that loan into the secondary market. I've given you what you need to know about the pricing. I've given you how much the borrower is going to pay to you in order to originate that loan is half a point. I've told you a closing cost that you as the originator are going to pick up, and I want you to figure out what is the profit that the originator makes on that loan. These profits are basically how lenders stay in business. Okay. All right. So let's go back to the final point, which is servicing. Um, Servicing is what happens after a loan is originated. So you, as a borrower, write a check or more likely have your bank send money out of your checking account to the lender. And then you take it and send that money to the security, to that Fannie Mae, to that Freddie Mac security. And we're going to talk much more about securitization later in the course. So don't worry too much about how that works. But you're the middle person taking money from the borrowers and sending it to the owners of that loan. When you have a borrower that always, always, always makes their payment, this is easy. You're basically getting paid to do very little work. But here's the hard part is if mortgage payments are late, now you have to pay attention. Okay. And that can put real pressure on you. You have to reach out to the borrower. You have to say, oh, why are you late? And very often, if a borrower is just 1 month late, it's because something happened, like they changed bank accounts or something along those lines. But when you get into 60, 90 days late, now you have a problem. Now you have to take care of it. Now you have to make sure that either the borrower repays the loan, including the overdue interest, or you start with foreclosure proceedings, which usually happen after 90 days. Depending on the state that you live in, foreclosure can be very easy to very difficult. Foreclosure meaning that you are taking the house away from the borrower. If you get to that position, you become what is called a special servicer. Isn't that special? Um, and some states, it's very easy to take people's houses away from them. Surprisingly, California is one of those states. In other states, it's nearly impossible. New York, New Jersey, Florida can take years before you can get the house back. Okay. And in a post-COVID world, borrowers now can often ask for automatic forbearance. So let's say they lose a job or have a health issue. What will happen is they can get forbearance. And the way that works is you stop making payments. You still owe interest that's going to accumulate because you haven't made those payments. But then you restart when you're able to. And you, the borrower, you, the servicer, have to keep track of that, figure out what the loan balance is, make sure they start to repay. And ultimately, when they sell the house or refinance the loan, that's when that excess interest gets paid. But that's a lot of work. And maybe you're not getting paid enough in order to take on that work. Okay. So, the big thing about servicing is with Ginnie Mae is very often the originators don't have a lot of money because they're not banks. And even though they will ultimately receive insurance payments for mortgages that are late, it can put real strain on them. And that's something we will talk about in class. So, see you Thursday, mortgage participants. Take care.